Welcome, ladies, to this session of our preparation for our exam. Right. Please note that we are not doing the paper that you'll be writing, but we are doing the concepts that I expect you to face. So as we do these concepts, please make sure that you understand the concepts, not the answer. It's not about the answer, it's about the concepts. And please, we won't be able to do everything, as you can see, because of the limitation of time. Actually, we'll do as much as we can until around 4. Then the rest you will try to do on your own. But as I said, when you're trying to do on your own, if you see that it's horrible, feel free to call even after. I think today I'll be done by 8. I'll be done, so you can call anytime after 8, and you can also call anytime before 8, before 8 in the morning tomorrow, and you can call in the evening tomorrow. After, I think I'll be finishing around 8 again. So usually I'm busy 8 to 8 weekend, right? So please feel free to contact me. Even late, feel free to call. Feel free to call. Is that right? So I will give you the other number that can be there even 24 hours. Even if you call it 1, I will be, because I know you're writing. That's why I'm saying that even at 1. Don't worry about anything. As long as you are studying, you want to understand. But tomorrow, please, you have enough sleep. Tomorrow you have enough sleep. That's why I think when Kolofelo was suggesting that we do this one tomorrow, I said, no, we can't do that. I don't usually want to meet people a day before their exam. That can create a lot of confusion when you now see new things and you start panicking unnecessarily. So it's rather better we meet today, so that by tomorrow you're sorting out all problems. Whatever we've discussed, what you don't understand, you are discussing with me, we are sorting it out. And please, I think this time, as I said, don't trust in calling than in sending a WhatsApp, because your WhatsApp, I might see it tomorrow. Trust in calling. So if please you have got an issue, please feel free to call me. Then I can be able to address whatever it is. So we'll start from the beginning of this paper. Want to try to do as much as possible on that first paper. So we'll try to be fast as possible. So please, when we do calculations, do them faster so that we can be able to cover as much as possible. Right, we'll start now, and then we'll take a break around half 2. We'll take a break around half 2 for about 10 minutes, 15 minutes. Then we'll continue until around 4. Right, so we'll do as much as possible. Actually, there are things that I want to make sure that I do, which is the effects of transactions in Forex. I should definitely do it. Right, so let's look at this question. Was it the one that I was starting with? No, it's not still this one. Okay, that's the paper. Okay, sorry. Right, so we're starting with the, I see that I didn't open the paper that I wanted to do with you here. Right, it's this one. Power energy is an integrated energy. Right, sorry. Power Energy is an integrated energy and chemical company with a 31 December financial year end. The company's head office is in Bilabila, Limpopo, with projects across South Africa. The company is 31 December year end. Right. Disclose the following notes to the annual financial statements of Power Energy Limited for the year ended 31 December 2021. We need PPE, we need non-current assets held for sale, and we need deferred tax, the chemical division, and machinery only. Your answer must comply with the requirements of international financial reporting standards. Right. It's very important that when you are on number 1, read all your required and see all the calculations that you want to do. Remember that most of your time will be on the calculations. If you see, like here, this question, they usually give you a guideline of 97 minutes. Of these 97 minutes, 60 should be on calculations. Then about 37, even less, will be on doing your answer. I think you remember, some of you have done the PPE together. When you have done your notes, your PPE does not even take 10 minutes if you're alone, because we're in class, we can take 20 minutes or so. But if I'm alone, if I've done my calculations, my PPE should not even take 10 minutes to prepare. So make sure that you've got your calculations, and make sure that all your calculations, you number them in your exam, because please, numbering is very, very important, because you might find a marker who is impatient and they don't have time to look around to see your answers. So what will happen is they will not mark you correct if they don't see your calculation. So please make sure that all your calculations, you number them, number one, and then where you show where your answer is entered, you also state that it's coming from calculation one, so that they use the marker can know what is happening. Right. So as it is, we know that we need the non-current assets held for sale. We need the deferred tax for the chemical division and the machinery. Right. So at the end of the day, that means we have to identify all items of property, plant, and equipment. And for all items, we have to calculate the cost. We have to calculate the carrying amount at the beginning of the year, which will also involve calculating the accumulated depreciation at the beginning of the year. Then we calculate the movements during the year. That is things like revaluation, additions during the year, depreciation during the year, any disposal or any impairment. Then on non-current assets held for sale, if you see 20 marks, that means there are a lot of things. We also have to take into account any impairment that might be required then. Right. Then deferred tax for the chemical division and machinery. Then we should also calculate the tax base. Right. So let's start from the, I would start from the additional information here and accounting policies. These are very important because they will guide you when you are doing your calculations. For you to calculate depreciation, you should know the policy of the company in terms of depreciation. Are they using the straight line, or are they using the units of production, or are they using the reducing balance? So it is very important that you read your policy. Right. Owner occupied land and is accounted for using the revaluation model. It is the policy of the company to realize any revaluation surplus upon disposal of the underlying asset. It is company policy that revaluations will be made with sufficient regularity to ensure that carrying amounts do not differ materially from which would be determined using fair values at the end of the reporting period. So there will be a depreciation calculation there. Right. Then we said owner occupied buildings are accounted for using the what? Cost model. Land, there's only revaluation, there's no depreciation. Right. So buildings, since they are using the cost model, there's no revaluation on buildings, but there will be depreciation. Actually, these days they don't examine you on the revaluation of buildings. Right. Depreciation on machinery is provided for according to the unit of production method over the estimated useful lives of the assets. So we should know that a depreciation, a machinery is on unit of production. A depreciation of distillation columns is provided for according to the straight line method over the estimated useful life. Amortization of intangible assets are provided for according to the straight line method over the estimated useful lives. Relevant pre-tax discount rate is 11% and the inflation rate is 7%. The South African normal tax rate is 28%, CGT is 80%. Right, you should know that. Please be very careful in your exams, because it seems as if they are now using the 27 in most of your exams. So don't just assume that the tax rate is 28%. Don't just assume that the tax rate is 28%. Right. Taxation. The South African Revenue Service allows for the following capital allowances. A tax allowance on the machinery according to Section 12C of the Income Tax Act, allowing a 40% deduction in the first year and 20% deduction per year in the following 3 years. That is the 40-20-20-20 rule. We shall use it when we determine our tax base for the sake of the deferred tax. Then a 5% annual building allowance on both the buildings according to Section 13(1) and 13(Queen) of the Income Tax Act, respectively, according to the straight line method. Right, deferred tax is provided on all temporal differences in accordance with the statement of financial position. That is a standard statement. I think that's all. Right, is there anything that you don't understand on the additional information before we answer? Right, so we'll go to our assets. So your first thing is to go asset by asset. You should know your year end. Our year end is 31 December 2021. our year end is 31 December 2021. So when you do your calculations, first calculate your accumulated depreciation up to 31 December 2020. Why? So that we can have our carrying amount at the beginning of the year. Then you proceed. Right. So let's identify all items. Let's do all calculations actually. So that when we do the solution, we'll do it at once. Right. Chemical division. On 1 April 2019, power energy. So also this chemical division, remember that is the one that they've asked us to also do the deferred tax. So we should also calculate our tax base of the assets and also calculate the deferred tax. Right. Did they say calculate or do the notes? There are two things. Calculating deferred tax and doing the note are two different things. Deferred tax or we're doing the note. Okay. So let's start with the chemical division. On 1 April 2019, Power Energy purchased an old factory at a cost of 4.6, land 800, building 3.8. Transfer fees to register the property at the deeds office amounted to 270,000 and was settled in cash. Additional significant work was needed to upgrade the factory building according to Power Energy Limited operational requirements. An invoice of 1.5 was sent to Power Energy by the contractor for the upgrade work on the building. The contractor has a 2-month period after work is completed for settlement of invoices. Power Energy Limited was granted 8-month period by the contractor to settle the 1.5 invoice. The contractor considers the 8-month period to be material. The factory building was available for use as intended by management on 1 February 2020 after all the upgrades were completed. The factory building has a total useful life of 25 years and 200,000 residual value. Right. On 31 December, the fair value of the land was determined to be 1 million and the residual value was revised to 270,000. And useful life of 25 years remained unchanged. All right. So we have to do our calculations here. We have two assets. Land and buildings are not combined in this module. We separate them. So we have to do calculations for land and we have to do calculations for the building. Right. So let's do our calculations. Right, let's start with the chemical division. We'll start with our land. So in an exam, we will be numbering these things. Right. Your land, there will only be revaluation. Right. We know that this land was bought for 800,000. Right. And on 31 December, the fair value of the land was determined to be 1 million. Right. So it's 1 million. So say so it's changed from 800,000 to 1 million. The residual value is it's about the buildings here. Right. So say 1 million minus 800,000, which is equal to 200,000. Then we'll go to our buildings. This is where most of the work is. Right. Let's first determine our cost. Remember, when you are determining the cost of an asset, it's the purchase price plus all other additional costs that are incurred to acquire it. Things like transport, installation costs, testing costs, import duty, like for the building, those architecture fees, upgrades, all those things will be included. The transfer fees, they will be included in the cost. Right, so we'll have our purchase price of 3.8. We'll have our transfer fee of 270. Right. So we have purchase price. Is 3.8. We have transfer fees. So all these are added to the cost. Legal fees, inspection costs, 270,000. But there's a story on them. Upgrade. The upgrade was 1.5, but it was settled on credit. That means we didn't pay for cash. Right. Now, the normal period for the contractor is 2 months, but we're given 8 months. And the period was considered to be material. When they say it's material, that means there's a significant financing component. That means the actual cost is not 1.5, but you are being charged the 1.5 because you are paying late. So there's interest included there. So in the cost of the asset, we don't have to include the interest. So we have to determine what could have been the price if he had paid now. So that means if the contractor considers the 8 months to be material, that means when he charged us the 1.5, he took into account the fact that we're paying after 8 months. Otherwise, if we paid him now, we're going to pay less. So you will be supposed to calculate what could be the present value of that amount. So whenever there is a delay of payment beyond the normal terms that are granted by the supplier, then you have to take into account any finance cost. So our cost will be excluding finance cost, right? So we can say our interest will be according to the pre-tax discount rate. I think when we read, we were told that the pre-tax discount rate is, we use the pre-tax discount rate to discount, is 11%. So we'd say our interest over the 11 months, it's 11% times 8. Sorry. First of all, I should talk about the interest. I should state that we are dealing with what? Upgrades. This sheet I will send you later. Times 8 divided by 12. What do we get? What do we get?
Hmm? 0.073.
Are you saying it's 0.073 or 7.3?
We can say 0.07 and remove the 3.
I wanted it as a full percentage. Are you sure that is 0.07 or can you just take the 11 as it is?
Okay.
Mine is 7.33. I'm not sure if it's fine.
7 point what?
33.
Yeah. Okay. That is the interest over the 8 months. Right. So to find our present value, you say you take the amount that is given, then you multiply by 100, then you divide by 107.3333. That's what we do, how we find our present value. But if it's being delayed by 2 years, for example, you don't have to do this. You can just do future value, your N, your I. But as long as the period is less than a year, this is how you do it. You first convert the interest to the effective interest over the months that we're talking about. Then you find your present value by multiplying by 100 divided by 100 plus that interest. What do we get?
$139, 7515, 96.
129,
No,
75,
no, 139.
17.
No, 39.
Yes.
7515, 96.
Right. Right. So would say that would be the value of the upgrade. So always when they say there's a significant either they will say there's significant financing component, or they will say the period is considered material. Then you know you have to calculate the present value. Right. So this is the cost of the asset now, after adding everything. Right. So this is our cost of this building. Any questions on that cost, especially on the upgrades? Right, no questions. So we'll continue. Right. Then accumulated depreciation. First of all, we have to calculate on 31 December 2020, please. You have to know we are doing 2021. So first of all, you have to calculate up to the end of last year. Right. So remember, depreciation is provided from the date that the asset is available for use. You should know those two key dates. The date when the asset was available for use is used by accounting for depreciation. Then the one that it was brought into use is used by SARS for granting tax allowances. So when we want to calculate the depreciation, we have to find out when was the asset available for use. We are told here that the factory building was available for use on 1 February 2020. Right. Remember that our current year is 2021. So we want to find the depreciation by 31 December 2020 first. That means by then it had been in use from 1 February, that is 11 months. And it had a residual value of 200,000. It only changed during the current year and the useful life of 25 years. Right. So would say our accumulated depreciation would say 5,467, 516. Then you subtract your accumulated, your residual value, which is 200,000. Then we divide by 25. So it's your cost minus the residual value divided by useful life. But let's take into account that it was only ready for use on 1 February 2020. So it was not therefore available for the full year. It was only available for 11 months. Right. Right. So what will our month, that means 11, divided by 12. What do we get?
193, 142,
193.
142.
What?
You're putting it in the wrong place.
Sorry. What happened? Oh, sorry.
Yes.
193,
142.
142. That's it to the nearest range, isn't it?
Yes.
Right.
Yeah.
Then we get our carrying amount on 31 December 2020. Right. These figures are important because they are the ones that we are going to include as the carrying amount on the carrying amount at the beginning of year. So always know that first of all, you have to end on last year so that you can have these two figures. We need them on the carrying amount at the beginning of the year. Is that right? Right. Then we'll have our depreciation for the year. Right now for this year, we are told that on 31 December, the residual value was revised to 270, but the useful life remained at 25. Right. There will now be a change in accounting estimate according to IAS 8 and IAS 16. Right. When the residual value changes, you will now, like a change in residual value, it's applied prospectively. We don't apply it retrospectively. So we don't have to go back and adjust the previous years for the 270. It will only be adjusted from this year going forward. That's what we mean when we say prospective application. So the depreciation for this year, although this decision they made it on 31 December, the depreciation for 2021 will now be calculated based on the new residual value of 270. And number two, you will no longer be calculating your depreciation on the original cost of 5467. You will now be calculating it based on the carrying amount at the beginning of the year. So whenever there is a change in residual value, you will now calculate the depreciation based on the carrying amount at the beginning of the year. And number two, you now use the remaining useful life, taking out the 11 months that it already passed. So to calculate our depreciation, we're going to take the 52, not the original price of 5467, 5274374. But if they had not changed the useful life, we're still going to use this 5467. But when they change, there's a change in useful life. When calculating your depreciation, it will now be based on the carrying amount at the beginning of the year, whether there's a change in useful life or a change in residual value or a change in the depreciation percentage. Right, minus the new residual value, 270,000 times 12, which is the months in this year, divided by the remaining useful life, which is about 289 months. Where am I getting my 289? The original useful life of 25 times 12, we get 300 months. Then you take out the 11 that had already elapsed in the previous year. So the remaining is 289. So we'll use the remaining years from the current year. The 12 is the 12 months for this year. The 289 is the 25 times 12 minus the 11 for the previous year. All right, what do we get?
Um, 207
207
794
794.
4.
Right. Then we get our carrying amount at the end of the year. So please make sure that you familiarize yourself with the how we calculate our depreciation if there's a change in residual value or change in useful life. That's it on this one. Any questions? It's cheap stuff, isn't it? And cheap principles. Right. Heavy alcohol division. Due to the ban of alcohol consumption in transportation, Power Energy Limited decided to sell the assets of the heavy alcohol division in a single transaction on 30 April 2021. All the criteria to classify the disposal group as held for sale, as stipulated in IFRS 5 non-current assets held for sale and discontinued operations were met. The sale is expected to be completed by 1 February 2022 for cash. The fair value less cost to sale of the disposal group on 30 April 2021 amounted to 5,203,738. Towards the end of the current financial year, Power Energy Limited experienced an increase in ethyl alcohol sales due to introduction of sanitation by various governments to combat COVID-19 rising infection. The fair value less cost to sell of the disposal group was revised to 5,090,000 on 31 December 2021. Management is committed to the sale of the group. The following are the assets and liabilities of the heavy alcohol division. Right. So we've got those assets. Machinery. A Power Energy Limited purchased a specialized alcohol making machinery on credit from a German company for $200,700. So you should know that this is bought in Forex. And we know that when we buy an asset in Forex, we convert it at the spot rate on the transaction date. And the transaction date depends on the type of sale. Right, and the machine was shipped free on board on 1 May 2019. If it's shipped free on board, the day of shipping is the transaction date. So we'll translate it on the day that it was shipped on 1 May 2019. On the day, shipping costs of 26,980 were settled immediately by Power Energy Limited. So that means the shipping costs will be added there. It was agreed between the supplier of the machine and Power Energy Limited that the cost to assemble the machine will be shared 60% and 40% respectively. So we are going to only include our 40%. Well, they said 60-40 respectively. The one who is given first is the supplier, so you pay 60. So we're going to pay 40. So on the assembling cost, we should remember that we only add 40% our cost. A consultant from Germany and one permanent employee from Power Energy Limited will work on assembling the machine. The following costs were incurred. Right, we've got those costs there. Those are the costs. There's a consultant and one permanent employee there. Right. The permanent employee earns 87,000 per month. The salary was increased as per salary agreement signed with the union. All the permanent employees are entitled to inflation plus 1% effective from 1 July 2019. A total of 42 days, working days, 2 full months was spent on assembling the machine from 1 May 2019 and completed on 30 June 2019. So he worked 2 months. 1 May. So in May, there was no increase. The increase only came in June and completed on 30 June. So in 1 month, there was no, we didn't have an increase yet. But in the second month, that's where the increase had come in. So that's when we are going to take into account the increase. A permanent employee spent 70% of his time on assembling the machine. So 70% of his salary will be allocated to the assembling of the machine. 70% of his time will be allocated to the assembling of the machine. Right. So the machine includes distillation columns that needs to be replaced every 3 years. On 31 March 2021, management decided to replace the distillation columns with better new distillation columns to increase the efficiency of the machine. On the date the machine was purchased, the cost of the distillation columns was estimated to be 250,000. The new distillation columns amounted to 350,000 and will be replaced every 3 years. The old replaced distillation columns were sold for 100,000. So there is a what we call a major component. There's a part of an asset which has got a useful life, which is different to the machine. Because if you can see that the machine, they are using the units of production, but I think we read on the policy that for the machine, if you check here, depreciation on the machinery, they're using the units of production. And on the distillation columns, they are using the straight line method over the useful lives. Right. Then they said, during the assembly period, a total of 300 liters of alcohol was produced. The alcohol was sold for a profit of 5,000. The machine was finally available for use as intended by management on 31 July 2019. The machine has a useful life of 1 million liters of alcohol and a residual value of 150. A total of 17,000 liters were produced for the year ended 31 December 2019, including the liters produced during assembling of the machine. A total of 36,000 and 40,000 liters were produced for the year ended 31 December 2020 and 31 December 2021, respectively. The alcohol was produced evenly throughout the year. The following dates and exchange rates are applicable. Right, I would give you just a minute. Can you just a minute or two just to go quickly through that so that we can be able to see the story that is there, so that when I start to go through, you understand what we're talking about. Just quickly browse through. Right. I hope you have read. First of all, let's determine the cost. Right, these $270.700 will be translated using the spot rate on 1 May 2019, which is 1540. That's what we'll use. Right, so we'll say here's the alcohol division. First of all, I want to determine the cost. Right. Purchase price. That's 200,700 multiplied by the spot rate on 1 May, which was 1540. What do we get?
Three zero nine zero
309
7
7
0. No, 0. No, sorry. It's 3090780.
like this.
Yes.
Then
Yes.
there is shipping cost of 2698. Then there is these assembly costs. Let's calculate them. We have the consultant. First of all, we've got the consultant, the flights and accommodation, 45,000. Then we've got the consultant. The daily allowance. They said what? It's 700 per day. And they worked, we were told that they worked for 42 days.
Yes.
So that would be 700 times 42. What do we get?
Two nine 400.
What?
29 400.
29.
400.
Thank you. Sorry, there is a sound. I can't hear properly. Sorry about that. Then there's consultant fees. We're told that they were 5,000 per day. That's you earning 5,000 per day there. How much is it?
210,000. 210,000.
Thank you so much. Then we've got permanent employee. So if your employee, please remember that this is not MAC, you are not doing MAC. In MAC, that's when you say these permanent employees is a committed cost because you're going to pay them. But here, when we're doing FAC according to IFRS, if your employees work in constructing an asset, their salaries during that period should be added to the cost of that particular asset. They are considered to be a direct cost. So don't forget that you are not in Mark 3701. If it was Mark 3701, remember we're going to ignore this cost. Right. It was 87,000. So for June, it would be 87,000 for May. But in June, it increased by inflation plus 1%. Our inflation were given that it's 5%, 7%, sorry. This is the inflation. So that means it increased by 8%. So there was an increase of 8% in so say the 87,000 then we add the one for June. Remember, it was only 2 months, 87,000, then add the 8%. Then, but we should remember that he only spent 70% on the assembly. So only cost the 70%, the other 30% will be allocated to the other jobs that he was doing. So we would say 87,000 plus 87,000 multiplied by 1.08. This is to take into account the increase. Multiplied by 70%. What do you get?
Okay, I am getting 126,672.
Thank you. So this is 411,072. This will be our total cost. Then we have to allocate part of the cost to the distillation columns. They said that on the date the machine was purchased, the cost of the distillation columns was estimated to be 250. So if there's a significant column, a significant component, you allocate a cost to it. Right. So I would say 250 is for the distillation columns. That means the machine, the rest is the machine. So you allocate your costs. Right, why do we have to separate? Because their useful lives are different, so we have to calculate their depreciation separately. Right, so now we'll
Can we please go back to that permanent employee, that 126 there
on the Excel? Yes.
Yeah, it's giving me a different answer.
Yeah, I would ask you, can you please, all of you, can you just try to recalculate so that we see what is happening there?
I'm still getting the same.
Are you making sure that the 7, you are first finding what is in the 87,000 plus 87,000 times 1.08 first? Then after getting that, then you multiply by 70% after adding everything in the bracket first. My sister, what were you getting?
Oh, now I got it.
Okay, thank you.
Thank you.
Right, so I would say the machine, distillation columns, then the total. Right. Cost. $3,278, 832, 250,000. Oh, I left something here. I left something here. I remember that there was something that, can we go back? During the assembly, 300 liters of alcohol was produced, and the alcohol was sold for a profit of 5,000. Right? If you do the testing or the assembly, and then you produce something, and then it is sellable, whatever selling price of those liters will reduce the cost of the asset. So whatever units you produce, so we'll have sale of alcohol produced in assembly, which is equal to what? 300 liters times 5,000. What do we get?
$1.5 million.
Hello?
1.5 million.
145.
Yep.
145. It can't be 145 this one.
1.5 million.
Okay.
1.5.
Right. I now hear you. Sorry.
Yes.
I did as if you were saying
So-
145. So I was saying, how always does the 145 comes from? Because 3 by 5 was giving me 15 there. Right. So C39. That will change our total. Right. So whenever, if you produce some goods, the net realizable value of the goods produced during testing or assembling are used to reduce the cost of the asset. Right. So this one is actually this one here. Sorry, this one is what? Right. Then we have our accumulated depreciation. When was we have to be very careful that the distillation columns were then replaced. They were replaced on 31 March 2021. So it was in the current year, so we don't have to worry for now. So accumulated depreciation, 31 December 2020. Right. On the machine, we know that the machine has a useful life of 1 million liters and a residual value of 150. Right. A total of 17 were produced in 2019, a total of 36 in 2020. So we're ending on 2020. So say the 17,000 plus the 36 minus because they are saying that this including the liters produced during the assembly. This 17 includes the liters produced during assembly. So we have to take them out because those ones were produced before it was ready for use. So we're going to say 17,000 minus the 500, 300 plus 36,000. We divide this by million. Then we multiply it by the cost, which is 1,778,832 minus the residual value, which is 150. That is for the machine. What do we get?
Okay, I am getting 858394.
Right.
839. Yeah.
Okay, thank you. Then the distillation columns, we know that their depreciation is over 3 years. So let's say 250,000 divided by 3, multiply by, remember that it was ready for use on it was completed on 30 June. Then they said it was ready for use when? I just want to check to verify the date that it was ready for use. Maybe we can assume that is 30 June. I don't see any other dates here. So we can assume that is 30 June. So by 31 December 2020, the distillation columns had been used for 1.5 years. 1.5 years. That is 6 months in 2019 from July up to December. And the, oh, no, yeah, it's given. The machine was
Yes.
finally available for
31
use in 31 July. So in July, there were only 5 months. Then in 2019, there were 5 months. Then in 2020, a full year. So it multiply by 17 over 12. 17 is coming from the 5 months in July, and then the full of 2020. Remember, we're calculating the accumulated depreciation up to 2020 because we need the carrying amount at the beginning of the year. All right, what do we get?
It's 118056.
Right. Then we get our carrying amount at the beginning of the year. Right. Now, during this year, there are two things that happened. Number one, by on 30 April, the assets they made, the division was now a non-current asset held for sale. So it will now be measured in terms of what? In terms of IFRS 5. Right. So we should be very careful there. Then also number 2, on 31 March, they replaced the distillation columns. So we can say, first of all, let's start with 31 March. Depreciation, 31 March 2021. That was before the reclassification. That would be on the distillation columns. That would be 250,000 divided by 3 years, multiplied by 3 divided by 12. The other 3 is for 3 months, January up to March. What do we get?
$208.33.
Right.
Yep.
Then we'll have what we call derecognition. That means these distillation columns will be derecognized because they are no longer there. They are now going to be replaced. So they have to be removed from our total here. Right. Then we'll have our depreciation, our addition, sorry. At cost. Right. The moment they derecognize this, they then installed the new distillation. The new distillation columns amounted to 350. Right. So that's 350 is the new cost here. Right. On the date that our assets qualifies as non-current held for sale, we will have to provide for depreciation. We apply IFRS 16. So our depreciation on 30 April 2021, the date that our asset qualified for as a non-current asset held for sale. Right. The machine, we know that it produced 40,000 liters during the year, and they said that the alcohol was produced evenly throughout the year. Evenly, so that was equal. So we'd say 40,000 times 4/12. 4/12 is coming from the 4 months, January up to April. Right, times 4/12, multiplied by 1 million, the cost, divided by 1 million, the useful life, multiplied by 1,778,832 minus 150,000. What do we get?
$21,718.
1.
21,718.
Right. Then our columns. On our columns, we'll have a 350. Oh, no, sorry. I've put that one on the wrong column. This one is supposed to be here. It's for the machine, remember. Then the columns would be 350,000 divided by 3, multiplied by 1/12. Remember that they were replaced on 31 March. And this depreciation we're calculating on 30 April when they qualified, when the asset qualified is held for sale. What do we get?
9722.
Then on that day, these assets are then transferred to non-current assets held for sale. Right. So they will no longer be PPE from that date. But then we then have to calculate our depreciation on 31 December 2021. The purpose of this depreciation is to just check if there is impairment. It will no longer be recorded. That depreciation will no longer be recorded. It will just be there for the sake of testing for impairment. Right. So say on the machine, that means we'll now take the 40,000 multiplied by the rest of the months, May to December, divided by 1 million, multiplied by 1,778,832 minus 150,000. What do we get? So these ones now, it's no longer that depreciation will not be recorded. It's just for the sake of testing for impairment. From the time that an asset is available for you, is transferred to non-current assets held for sale, we will no longer be applying the IAS 16. Will now be applying IFRS 5.
43436.
43436, like this.
Yes.
Okay, thank you.
Yes. 43.
Then on the distillation columns, we'll now say 350,000 divided by 3, multiplied by 8/12. That is May to December. We get
I get 77778.
right. Then we get our carrying amount on the 31 December 2020. And this one will not be recorded. It's just for the sake of determining right. Any questions there? Right. Then remember that we also want to calculate our tax base. So our tax base, according to SAS, the cost of the assets, which we found to be, SAS do not separate the major component and the asset. They just take the asset as one. So according to SAS, the asset would be this one here. Let's just check if there is any, if they sometimes exams they can give them separately. What did they say on SAS? Yeah, they didn't say anything because normally SAS does not Does not separate. Then accumulated section 12C allowance, which is 2028,832 times 80%. Do you know where I'm getting my 80%? 40% in the first year, 2019, then 20% in 2020, then 20% in 2021. We don't need the one at the beginning of the year. We just want the one at the end of the year. So 40 for 2019, 20 for 2020, and 20 for 2021, which makes it 80%. What do we get?
162,3066.
Right. Then we get our tax base. So this one would need it when we determine our deferred tax. So for tax base, we just need the one at the end of the year, which we shall use to determine our deferred tax. Right. Then we are going to come back to the machinery, because when you classify an asset as non-current assets held for sale, we are also supposed to test for impairment. Right. So now let's first deal with the other assets. The intangible asset. Right. This one we need it for the sake of the non-current assets held for sale. Right. Power Energy Limited embarked research and development of patent for producing alcohol from fuel and solvents. The development and research costs for the development of the patent amounted to 1.5 million and 860. On 1 July to June 2020, the board of directors of Power Energy Limited determined that the patent satisfied all the criteria for recognition as a tangible asset. The following additional costs were incurred for the registration of the patent: legal fees 46,000 and registration fees of 1,500, with the 1,500 with the companies and intellectual property commission. The patent was registered on 1 December 2020, thereafter available for use as intended by management. The patent was determined to have a useful life of 5 years with new residual value. Right. So I would say, let's deal with the intangible asset. Let's first determine the cost. Right. So would check this purchase price. Right. Remember that there's development and research cost. The development and research, we only include the development cost. We don't include research cost. The research cost is treated as an expense. The research costs are treated as an expense. So when we internally produce our intangible asset, only the development cost will be included in the cost of the asset. Only the development cost. Right. So we'd have our purchase cost. Then we also add the legal fees and the registration fees. The initial registration is added to the cost of the asset. Right. So we'd say purchase cost which is 1.5. We only include the, it's not purchase actually, it's development cost. Only the development, we don't include the research. Right, then we'll have our legal fees, 46,000. Then we have our registration fees, 1,500. Right, our total cost, right. Then we have our accumulated amortization. On 31 March 2021. Was it 30 April? April 2021, when the group was classified as held for sale. Right. If you see, I'm not interested in the beginning of the year. Why? Because here we are not asked to do the intangible asset note. So there's no need for me to calculate the one at the beginning of the year. But if we're doing the intangible asset note, I was also going to do the calculate up to 2020 first. But since we're not doing the intangible asset, there's no need for me to do that. Right, it is the useful life for 5 years and the residual value of new. And on 1 June 2020, that's when it was it satisfied all criteria. So by 30 April 2021, it had been there for 11 months. 11 months. So would say 1,547, 500 divided by the useful life, which is 5 times 11 divided by 12. What do we get?
283,708.
Right. So then we get our what? Transfer to non-current assets held for sale. Is that right? Sorry, I think I don't have to put that line at the bottom. I still need something there. Then we'll have our amortization. Date 1 December 2021, which would be 1,547, 500 divided by 5 is now how many months? That's 8/12. That is from May to December. What do we get?
206,333.
26.
206. No, sir. It's 206 and 333. Yeah.
Right. Then we get carrying amount. Date 1 December 2021. Right. What did they say on our we're supposed to calculate the text basis of this? I'll come because they said on the text base they said capital division and machinery only. So I'll come back to those two. Right, our inventory, we are told that the carrying amount and net realizable value of the inventory on 30 April 2021 amounted to 75,000 and 85,000 respectively. There were no changes to the carrying amount or net realizable value of the inventory. So they were given, so there's no need to calculate. Then the heavy alcohol division bank statement from Mola Bank shows a credit balance of 100,000 on 30 April 2021. There were no changes to the bank balance at year end. So that's our bank balance. So then we have to check if there's any impairment. Right. Then we now to check if there's any impairment on the disposal group, we have to do a calculation of carrying amount of the disposal group. on 30 April 2021, the date that it was the group was classified as held for sale. We had machinery, right? The carrying amount of the machinery on that date, we calculated it. It was that transfer to non-current assets held for sale on 30 April. That's why I had to cut on 30 April would need this one here, right? Then we have intangible assets. On 30 April, we also have calculated it and we found it to be here. Then we've got the inventory. Inventory on 30 April, we were told that it was 75,000. We take the lower, that is 75,000, right? Then our cash, it was 100,000. It was a credit balance. That means it was a liability. When cash has got a credit balance, it's a liability. So that's negative 100,000. Then we get the total carrying amount. That is 3,250. Then we compare it to the fair value less cost to sell on 30 April. Right, we are told that the fair value less cost to sell on 30 April, the sale is expected to be completed on 1 February for cash. The fair value less cost to sell of the disposal group on 30 April amounted to 5,203,738. And here we're getting 3,250. So the carrying amount of the disposal group was way above the what? The cost of the carrying amount of the disposal group. So there was no impairment. There was no impairment. Right. So there was no impairment. Actually, so there's no impairment. So there's no need for us to test to go further and test for impairment then. Right. So now we can do our notes. Extract of the notes. The financial statements. Of power energy. For the year ended 31 December 2021. Right. We have the following assets. So we have number one, property, plant, and equipment. We have land, buildings, machinery. Total. So here now you will now be just be copying. You have now done your calculations, so you just be checking from what you did up there. Right, we have got the carrying amount. At beginning of year. We have cost accumulated depreciation. Right. Our length at the beginning of the year, remember that it was just the original price of 800,000. Our building it was the cost was, we calculated it earlier on. So you just be taking your figures now. So just be following where I take the figures here. This was our building. And our accumulated depreciation was the one following. It was this one here. Our machine, our cost was this. So here on the machine, we don't separate them on the note to PPE. The machine and the distillation columns, the distillation column is just a part of the machine. Then our accumulated depreciation was, so I'm just taking from our calculations. Any questions there? Then we'll have revaluation during here. Which is equal to, okay, we calculated this, that first calculation that you can see on your screen, 200,000. So it's 200,000. Right? Additions during here. Remember that on the machines, they bought a new, they added that they added the distillation columns for 350. Then depreciation during here. On the buildings, we calculated it. So we'll now just be plugging your figures now. The depreciation for the year. Then the machine will have to do additions because we recorded them separately. Depreciation for the year. Under PPE, we only record the depreciation before it was transferred. So it will be this 2833 plus this 31440. Remember, we had to calculate here so that we could recognize the part that was sold. So it will be this 2833 plus this 31440. What do you get?
Five two 323.
Right. So that's 52323. Then G recognition. That's the distilling columns that were derecognized. We also calculated that it was here. Then we have transfer to non-current assets held for sale. This abbreviation is permitted. This abbreviation that I've just used is actually allowed. Right. So that would be our machine. We calculated also the transfer. This one here. Then we can be able to get our carrying amount at end of year. We'll have your cost or gross carrying amount. We have cost or gross carrying amount because because of the revaluation. Remember that our land will no longer be at cost. So as long as there is an asset revalue, that's when we talk about a gross carrying amount. Then we've got accumulated depreciation. Right. Our land is now 1 million. This is 0. Our building, the cost remains the 54. But our accumulated depreciation will now be the 193 plus the 207. Right. Then our machinery, we no longer have machinery. It's now non-current asset held for sale. Our machinery will now be 0 because it's now non-current asset held for sale. Right. Then if there's an asset that is revalued, we have this land. Are we given the address? Because if we're given the address, we have to state the address. And if it was revalued, we have to state if it was revalued by an independent phone appraiser. Okay, we don't know that, so we can just say the land was revalued at 31 December 2021. If we'd been told that it was by an independent phone appraiser, we could have stated that. Right. If it had not been revalued, it could have been recorded at its carrying amount of at its cost, sorry. $800,000. Any questions? Do you have any questions there? Right. Non-current assets held for sale. Right. During the year, the company decided to dispose of the, what is the name of that division again? The heavy alcohol division. Due to the ban of alcohol. Consumption. We are given on the question this one. Transportation. All criteria for classification is held for sale. Was made on April 2021. And the sale is expected to be completed for cash on they said on what? 1 February 2022. The fair value less cost to sell of the disposal group was 5,090,000 on 31 December 2021. The assets in the disposal group are made up as follows. machinery, intangible assets, inventory, bank. Right, your machinery, you now include it at the carrying amount on 31 December, which was 1890. Our intangible asset, we do the same on 31 December, which was this one. Our inventory, remember they said it did not change at 75,000. Then our bank, it also did not change. Right, so there's no impairment that was recognized because the fair value less cost to sell was more. But actually, during the break, I'll just check if there's no impairment because I suspect there can be impairment there. Right. In number 3, analysis. Sorry, deferred tax. Analysis of temporary difference. Right. Just a second. Right. Revaluation of land. Land, the difference will be the revaluation. And for land, you always multiply 200,000 times 20 times 80% times 28%. Always there's capital gain on the land. So whenever there's a revaluation, remember that you multiply by 28% times 80%. What do you get?
Uh, 4,800.
Right. Then accelerated. Capital allowances on machinery. Right. Our carrying amount of the machinery on 31 December. Remember, we said it's what is our carrying amount on the machinery? It was 1890339. So we'd say 1890339 minus the carrying amount. So to get your deferred tax on the asset, you subtract the two, the carrying amount and the tax base. The tax base, we calculated it here. 405766. And this one is just by 28%. What do we get?
Okay. 415,680.
Right, now let's calculate the building tax base. Right, our cost of the building was this one here. Then our accumulated building allowance $5,467,516 multiplied by our percentage is we're told that it's 5%. Right, and remember that this was acquired in 2019. Right, so no, is it 2019? 2020.
22.
Right, so 2020, that's when it was available for use. Right, so we're going to say from 2020, that's that. 2020 to 2021, that's 2 years. Is that right? So multiply by 2, multiply by 5% times 2. I think you are going to get 546,752. Then we get 4920764. Right. So then here we're going to say accelerated building allowances. Check the carrying amount, which we have here, 506658. 5066580 minus 4920764 multiplied by 28%.
6,
What do you get?
80 minus 420, 764, 8%. It is 40. 40828.
Right. Then we get our deferred tax liability. These are deferred tax liabilities because the carrying amounts of the assets are more than the tax basis. Right. Any questions there? Right. So we'll take a break for this is around 26 to 3. Can we be back by 10 minutes too? I'll give you about 15 minutes. When we come back, I want to do a question on that paper. I want to do the effects of foreign exchange transactions. So you use the same link. I'm not going to, I'll just mute myself here and you can also mute yourselves there. So we'll continue in about 15 minutes. Thank you so much. Now I want to shift to the other paper. Just opening. Right, it's open. Right, we want to look at question 3. Question 3. Right. The managing director of Biz Limited is an engineer by profession and is concerned that his junior accountant has not been correctly applying to the relevant IFRS and has requested you to address the following issues and email him your response. Biz Limited is 31 December year end. Issue number 1. Biz purchased a piece of land in France for 100,000 on 3 March 2020. Its fair value on 31 December 2022 was 120,000. The land is not depreciated and is measured using the fair value model. The spot rates were as follows. So we're given the spot rates. Then we're told that Biliato Limited acquired a patent for its locally. Does it have the things that I want here? Let me just see, because it might not have the things that I wanted to test here. No, it doesn't have much. Did they give? Oh, let's see. It might have. Explain the IFRS implications of the information above and show the journals that should be processed. All right. Now, first of all, they purchased a piece of land for 100,000 on 3 March. The land will be okay. Let me just, because you should be very careful here. There are two things. Explain the IFRS implications of the information above and show the journal. So you're explaining and you show the journals. All right. So we can say I think I would need to, because it doesn't have much, but I think soon after I'll just send another one, then you can be able to deal with it. Right. Just a second. Right. So we're saying the acquisition of the land should be translated using the spot rate at date of acquisition. It's transaction date. Which is the date which is the date that the risks and rewards associated with the asset were transferred to the company. In this case, we don't have anything to the contrary, so would assume that in this case the date is what? 3 March 2020. Right, so that means here our general entry would be land. Right. Would use the spot rate of 18 rand. So they said what? It's 100,000. What will you get there? I think that will be, is it 1.8 million? Then we'll have bank or trade payables. Right. They didn't tell us whether it was bought for cash or for on credit. So that's why we are just saying bank or trade receivables. Right. Then they said narrations are required. Then that can be acquisition of land in France. Right. It's year end. The assets are restated. Considering that the entity is using, I think they said that the land is not depreciated and is measured using the fair value model. So it's not depreciated, it's measured using the fair value model. Right. Using the what? the fair value model. To the fair value at year end. Incomes, fair value adjustment. Is an income. And incomes are translated using average rate for the year. So here the fair value gain is equal to the land they acquired it for 100, and by 31 December it was now what, 120. Can you just hold on? Maybe I will just have to, I have to re-enter the meeting. Something is happening on my system here. Can I just re-enter the system just now? Just give me a minute. So I'll be coming back just a minute. I'm just switching off. Hello, can you hear me?
Yes.
Very sorry, I'd been I got shut off along the way, so I had to completely restart my system so that I could be able to join you. Very sorry about that. Right, we're discussing about the fair value gain. Is that right? So we're
Yes.
saying, okay, let me just. So there's a distinction between monetary and non-monetary assets, right? A debt. Oh, I didn't open again this one. My Excel sheet is not open. Let me just open the Excel sheet. It closed. Right. Right, it's now open. There's something that I want to read here. This purchased piece of land in France. Okay, okay. Its fair value of what's 2120 is not depreciated. Right. I said we translate it at the spot rate. Then at the end of each year, the assets are restated, considering that the entity is using the fair value model. The fair value adjustment. No, this one is not for this one here. Sorry about that. I think this part, I should remove this part here. The first part, I was on the right part. Right. All non-monetary items that are measured at fair value in a foreign denominated currency should be translated using the exchange rate. At the date when the fair values are determined. So that means the fair value of this property was determined on December 2022. So we should translate it at this ruling rate on December 2022. December 2022. Therefore, the fair value on December 2022 should be translated at the ruling rate on December. 2022. Right. So that means our fair value would be equal to the new value, which is 120,000 times 2045. What do you get?
$2,454,000.
Is what?
2,454 and the 3 zeros.
Right. So that means our fair value gain would be equal to 2,454,000 minus the 1.8 million, which is equal to 654,000. So then for this one, we would then say land SFP to increase it by 654,000. Then we'll credit our fair value adjustment. Right. So the non-monetary assets are not readjusted for exchange rate movement. But monetary assets are the ones that are adjusted movement in foreign currency. Except, oh, I've left something here because remember that this property is in France, isn't it? Is in France, so there's something that I left there because it's not in South Africa. It has to be translated on the, but that's the part that I'm talking about. Except, so I think I will come back to this calculation. Except if the asset is held in a foreign country. So if this land was if the asset, if it was not land, of course, land it cannot be here and then be outside. Let's say if it was machinery, if you buy it in foreign currency, then that's it. You don't have to adjust it. But because this land is in South Africa, in France, we have to adjust it. So please, I will come back to this one. So that means on 31 December, 2021. That's 2020 what? It was bought on 3 March 2020. Then our year ends are or we were not given 2020. We would have translated it also in 2020. We can say 2020 in 2021, it was now 20 rand 20. So we would say so on 31 December, the land will be revalued to the spot rate on reporting date. So this we're only doing it because the asset is in a foreign land. So we debit our land that would be the cost of the land, which was 100,000. Remember, it had not yet been revalued. So this one, can I just put a date here? That's 31 December. Let me just write that date. It's 2020. 2021. If we had been given for 2020, we're also going to deal with it. So multiply by the exchange rate movement, that is 2090 minus 18 rand. What do we get? So please note this adjustment, we're doing it because the land is in a foreign land. The asset is not in South Africa.
It's 290,000.
It's what?
290,000.
Right. So then here we'll have foreign exchange gain. Which is the what? Gain arising from movements in exchange rate. Right, then this one here, when we calculate it, we should subtract now the 290. Can we please readjust this one? Because this one is in 2022. So if you're answering this part will come after this part, because we have to start with 2021. So in 2021, they would have already increased the land by 290. So then in 2022, we have to take out that 290 when we're calculating the gain, because the other 290 was already recognized. What do we get?
I am getting 364,000.
Thank you. So, so this one is 290. I'm changing the wrong one. Yeah, 364,000. 364,000. What about that? So it's because we are doing this because the asset is based in France. But if this asset was in South Africa, we're not going to have any adjustment in 2021. We'll only do a revaluation when there's that revaluation there. All right. Then can we go to the other one? The other paper that I sent you now. I sent you another paper just now when I was trying to rejoin. We want to do question. It's question. Where is this question again? Question 2, part A. Was I wanted to do and also to deal with the intangible assets. October 2019, question 2, part A. Right, we'll just quickly deal with it. All right, Multiface Limited is a video entertainment and internet company listed on the JSE. The company has a 31 December March year end broadcasting rights and the software. Now our question is prepare. What we only want to do these two parts quickly. Prepare all the relevant general entries, including cash transactions, amortization, and repayment in the accounting records of Multiface Limited to account for the broadcasting rights and the foreign creditor on the following dates: 1 December 2018 and 31 March 2019. Right. The issue is on 1 December 2018, Multiface Limited acquired the exclusive rights to broadcast the UEFA Europa League in South Africa for a period of 5 years at a cost of 500,000. Legal fees amounting to 25,000 were paid immediately in cash on acquisition date to finalize this broadcasting rights agreement. Multiface Limited settled 250,000 of the acquisition cost on 1 December 2018. That is on that date in cash, whilst the remainder of the acquisition cost is payable on 31 March 2019. The broadcasting rights were available for use as intended by management, as well as brought into use on 1 December 2018. On acquisition date, a residual value of new was allocated to the broadcasting rights. The following dates and exchange rates are applicable. Right. So on acquisition date, we recognize this broadcasting rights using the spot rate on acquisition date, which is 16.21. So we'd say general entries. Right. Right, we'll debit our intangible assets. Remember, in assets, when you acquire an asset, when an asset increases, we debit the asset. Would say 500,000 plus 25,000, that is 525 multiplied by 16.21. So would say 500,000 plus 25,000 multiplied by 16.21. What do we get?
It's 510. 85, sir.
85.
Yes. 8510 250.
Okay, thank you so much. Then we'll credit our bank. Like, not all the amounts were paid. They only paid 250,000 plus 25,000. What do we get? I will not be putting general narrations for the sake of time.
Four 57750.
Then trade payable for the portion that we didn't pay on that date, which is 500,000 minus 250,000. Remember, they bought for 500,000, but they only paid 250. I think I put too many fours here, isn't it? Is it the fours
Yes.
that are too much here?
Yes, it's 4,500,000,
Yeah, okay.
4,457.
4,457,000.
Yes, 750.
Or the sevens are the ones that are too much. Okay, and this one will be
4052. 500.
right. So that will be our general entry on 1 December 2018. Then on 31 March 2019, the day that they pay the other 250. The first thing before you record the payment, right? So like this asset, we are not going to translate it on 31 March the year end because it's located here in South Africa. It's unlike that other one, right? On 31 March, the rand had moved to 1636. So there was a loss there because we now had to pay more. So before you record the payment, you record the loss or gain on the foreign exchange rate. So debit our foreign exchange loss. It's a loss because, okay, I want to show you that why is it a loss, right? If you are the one paying, if the rand deteriorates from 16.21 to 16.36, then we've lost. But if it was us we had sold, it could have been a gain because we receive more money. So in this case, we are the ones who bought, so that will be a loss. So there will be a foreign exchange loss. And the loss is only on the outstanding amount, which is 250,000 multiplied by the difference between the exchange rates, 16.36 minus 16.21. What do we get?
37,500.
37,500.
Yes.
Then we credit trade payables. Was that to increase our amount that we owe? Right. Then we also record the payment. That means we debit our trade payables. Now the payment will be made at the spot rate on the day, 250,000 multiplied by 16.36. What do we get?
Forty 4090 000. It's 4090.
It's what?
The other 4 is not there. It's 409.
Okay. Is that fine?
No, it's the zeros at the end, not 2.
Oh, you said 2 zeros. Oh, sorry. That's fine now. Then thank because we're paying.
No, it's 4090 000. Yes.
Right. Thank you. Right. So then that's it. So that means a tier end, we should always, if you are owing, because this one is a monetary asset. Trade payables is a monetary asset, or even trade receivables. If we are owed, we are supposed to restate that debt using the ruling transaction day rate every year and also on the date of the payment. So even if they're not yet paid, we're only going to do this one. But because that they were also paying on the same day, that's why we're doing both of them. Right. Can I proceed? Also, there will also be impairment. We are told that this is the residual value of new, and the useful life is, what was the useful life? Oh, okay. Let's also, there's also another part here. The broadcasting, okay, before I go to that, I want the number of years. The Broadcasting Authority held public hearings during the 2018 financial year to investigate anti-competitive conduct in the pay TV sector. After months of deliberation, the Broadcasting Authority decided to introduce legislation that will require companies to share broadcasting rights and to shorten exclusive broadcasting rights contract periods, with the aim to encourage competition and new entrants into the market. The promulgation of the legislation affected Multiface Limited negatively, and on 31 March 2019, the fair value less cost to sell and the value in use of the broadcasting rights were estimated to be 7.3 million and 7.5 million respectively. An applicable pre-tax discount rate of 11% was applied in the calculation. Okay, first of all, let's deal with the amortization. I'm looking for the, okay, it was for 5 years. Yeah. Right. Our year end is by year end, this year only 4 months. 1 December to 31 March is 4 months. So there will be amortization for 4 months. So we'd say amortization. We don't depreciate intangible assets, they amortize. So we'll take the cost, which is the 8510 above there, 250. Then we'll divide it by 5, the useful life, then multiply by 4 months, since it was only 4 months. What do we get?
567 350.
Then we trade it, accumulated amortization. Broadcasting rights. $567,350. Right. Now, because of the issues that they've told us, then we have to test for impairment. Right. Our carrying amount on this date of the broadcasting rights would be 8,510,250 minus 567,350. What do we get? I think I can calculate here. It's this minus that. We have that. Right. Whenever they tell you that any information that doubts the income generating capacity of an asset, you have to test for impairment. That's why I'm testing for impairment. Then the recoverable amount. Remember that there is impairment if the carrying amount of an asset is now more than the recoverable amount. There is impairment if the carrying amount is now more than the recoverable amount. And what is the recoverable amount? The recoverable amount is the higher of the value in use and the fair value less cost to sell. Right, our fair value less cost to sell is 7.3 and our value in use is 7.5. So we're going to use the value in use, which is 7.5, which is the higher. So you take the higher of the two. So our recoverable amount, that is the higher value in use, is 7.5. So there is impairment. Why? Because the recoverable amount of 7.5 is less than the carrying amount of 7.9. So there is an impairment loss. And that impairment loss is the difference between the two. So always you should test for impairment if there is a doubt on the capability of an asset. Then we're going to debit impairment loss. That's 442,900. Then we credit accumulated impairment loss. So that's it. Those are the general entries on the broadcasting rights. Any questions? Right. Then the second part, it wants us to do the intangible assets. But we also have another one. This one here. Software. During the 2018 financial year, the directors of Multiface Limited decided to enter the internet-based over-the-top TV, OTT TV industry. OTT TV is a method of distributing streaming media as a standalone product directly to subscribers over the internet. The company therefore embarked on a research and development project to develop a software program called Showtime. This software will be used by subscribers in the streaming process. Research commenced on 1 January 2018, and on 1 May 2018, all the criteria for recognition of the software as an internally generated intangible asset was met. Right, you should remember that only development costs will be included in the cost of the intangible asset. The research costs will be treated as an expense. We only need research costs if they want us to do the profit before tax note or the profit or loss account, because we would include them. Right. So development of the software was completed on 31 July. So that means only the costs from 1 May 2018 until when the development ended are to be included in the cost of the software. Right. Let me just quickly determine the cost of the software. Right. Remember that the months for let's remember in everything that the months for research was January up to April, 4 months, and development May up to July, 3 months. So 4 months for a research and 3 months for development, and we're only interested in the development 3 months. Right, Multiface employed 5 information technology engineers, each earning a monthly salary of 19,500 to work full-time exclusively on the research and development. Right, we are not interested in the research part, so would need the development part, which is 3 months, and there are 5, each earning 19,500. So say IT engineers salaries, you should be very careful. They can give you the full salary, or they can give you the monthly. So you should be very careful, or they can give you the annual salary. So here it's each. So we'd say 19,500. There are 5 times 5, then times 3, the 3 months that they were doing development. What do we get?
$292,500.
Right. Then the total administrative and other operational costs directly attributable to the software amounted to 100,000 and were evenly incurred during the research and development phase. Right, we're only interested in they are directly attributable. If the costs are directly attributable, we include them in our calculation. Right, but we're only interested in the part that was for development. So this 100,000 was earned evenly for research and development. So we're only interested in the 3 months for development, right? So we'll have administrative and other operational costs. Then we'd say 100,000 multiplied by 3/7. Remember that there were 7 months, but only 3 were for development. What do we get? What do we get?
42,857.
42,857.
Yes.
Right. Then
Yes.
on 28 February 2018, Multiface acquired computer equipment at a cost of 80,000, which will initially be exclusively used for research and development of the software, thereafter by the IT department of the company. The computer equipment was available for use as intended by management on acquisition date. On acquisition date, it was estimated that the computer equipment has an estimated useful life of 4 years and a residual value of 20,000 was allocated to it. Right? If you use one asset to manufacture another, the depreciation of the asset used will be included in the cost of the new asset. So it would also include the depreciation of the computer for those 3 months that we used it in the development. Right, would say 80,000 minus residual value, which is 20,000, divided by the useful life, which is 4. But then we multiply only for our 3 months of development. Right. What do we get?
$3,750.
Right. Then here they're talking about the amortization. The short-term software was available for use as stated by management on 1 September. On this day, an estimated useful life of 5 years and the residual value of new was allocated to it. Right. So we're going to say so that's it. You said 3,750, isn't it?
Yes.
Right. So we get the total cost. Then our amortization would be equal to 339,107. Right. We're told that this year the useful life of 5 years and the residual value of new. Right. It was available for use on 1 September. So from 1 September until our year end 31 March, there are 7 months. 7 months. So it'd say divided by 5, multiplied by 7/12. What do you get?
$39,562.
Right. Then, so we can do our extract of the notes to the financial statements. Of that's Multi-Face Limited for the year ended 31 March 2019. Right, we're doing the intangible assets. Now we separate the purchased and the internally generated. Internally generated. Then they say don't include the total. But if they said wanted the total, we're also going to include it. So you separate your internally generated and your purchased. Right. We'll have our carrying amount at end of year. Right. Both the development and the purchase, all of them happened in the current year. So that means at the end of the day, we didn't have any carrying amount at the beginning of the year, because the development only started in May and our year started in April. So that will be 0, 0, which will be made up of our costs and accumulated amortization here. So please, on intangible assets, we no longer have depreciation, it's amortization. So it's 0, 0, 0, 0. Then additions during year. Right. Our additions on the purchased, we calculated the cost. We found it to be 8510. Right. Then on the internally generated, we found it to be 339. Right. Then we'll have amortization during year. Right. On the purchased, we found it to be our amortization, we found it to be this one here, 567. Right. On the internally generated, we found it to be this one here. Then we have impairment loss. During year, it was only for the purchased. We found it to be this one here. Then we get our carrying amount at the end of the year. Oh, this one was at the beginning. Why did I write end here? This one is at the beginning. Right. Our costs. Right. This will be accumulated depreciation and impairment. Right. Our cost is this one here. Accumulated depreciation and impairment, we add them together. Then we get our difference. Right. Then you are supposed to state that the broadcasting rights. You have a carrying amount of 7,500,000 at year end, and a remaining useful life of, it was, remember that it had a useful life for 5 years and 4 months have gone. So they were left with 4 years and 8 months. 4 years and 8 months. So 4 years and 8 months. Right, then the license is a carrying amount of 299,545 at year end, and a remaining useful life of 5, remember that it had 5 years, so 7 months have gone. So that means a remaining useful life of 4 years and 5 months. Any questions? So we can now be able to go and kill it. Okay. So my friends, you practice including the questions that I've not done. You can call me anytime, I think after 8 or before 8 tomorrow, or after 8 tomorrow. As I told you that I'll be busy between 8 and 8. Right.
Okay.
So please, I wish you all the best, but please let me be your friend between the next 2 days. Ask any questions and we help each other.
Are we going to get this answer, like this solution that you're busy with? Can you please send it to us?
Yes, I will send you, I think, in the group within an hour.
Okay.
Okay, thank you so much. So wish you all the best and God bless you, Richard.
Thank you.
Thank you, sir.